You're watching Stockwatch this week with me, Ntaoleng Lechela, and joining me to pack your stock-related questions today are on Zoom are Chantal Marx from FNB Wealth and Investment, as well as Jason Horn from Steyn Capital Management. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at BusinessDayTV using the hashtag Stockwatch. So Chantal is dealing with a bit of technical issues. I'll get started with Jason as we give her some time to sort that out. Jason, volatility remains the name of the game. It is day 7 of the war out in the Middle East with no end in sight. And market reaction has been quite choppy. One day we're in the green, the next we're in the red. Just your read on that in terms of what we've seen playing out over the past week.
Yeah, thanks for having me. I think you are correct. They're probably understating the choppiness of trade that we've seen over the last week. Look, I think market reaction overall is pretty perplexing, and I must be honest, quite worrying. I mean, if we look at kind of what the markets have done since the start of the war, outside of Asia, there hasn't been a huge amount of overall weakness. I mean, if we just have a glance at what the S&P 500 has done over the week, I think, months to date, we're only down by about 0.5%. So It does seem that, yes, markets are worried. And obviously, we've seen huge moves in the likes of Korea and also in the various currencies in the emerging market space. And it does seem that, more broadly speaking, overall, we have seen a lot of de-risking, particularly around commodities and US treasuries, where we talk about these black swan events where that correlation is one. So you typically see really weak performance around the likes of the gold and stuff, where you've got these really liquid assets that have done really well for so long, as investors just de-risk, kind of go to cash and see what happens from there.
And I mean, over the past, 5-6 years, there's been so many black swan events. You even ask yourself if what we're dealing with right now is a black swan event, from the war in Ukraine to COVID to what we're seeing playing out at the moment. Of course, what's playing out over in the Middle East, if it is prolonged, there are severe consequences when it comes to the global economy. There's been, concern around fuel price increases, which would in turn lead to inflation, higher inflation. With that, we have seen some traders, of course, push back on rate cut expectations over in the US. Are you pricing that in, the possibility of, I guess, a delayed rate cutting cycle over in the US?
I think probably around the world, to tell you the truth. I think there are a few things at play here. I think maybe just to take a step back to the start of your question, if we think about what's going on, what's quite worrying is this isn't a financial event that is causing stress in the markets. It's irrelevant where interest rates are at versus what's going on in the Middle East right now. So that's the nature of when I talk about a black swan event, very similar to COVID, in that it's not a financial thing that's causing the stress here. And yes, elevated oil prices will feed through to inflation, and then we need to question how long is that going to be. I mean, markets seem to be pricing from where the price of oil is now. It's probably going to be for another week or so, but we just don't know. So if you have that extended period and all this uncertainty, short-term rate cuts are probably off the table completely, as it's probably prudent for most central banks to have the wait and see approach. And then at the same time, one needs to start thinking longer term. If this is 5 to 9 weeks, then you could actually look at a global growth slowdown, and then you could be looking at a global recession, which is very worrying for markets.
Chantal, let's perhaps bring you in at this point and look at the kind of ramifications this could have for the South African economy, right? Of course, with SA being an open economy, what we're currently seeing out with the war playing out is a higher oil price and a weaker rand. This is one of the scenarios that Governor Lesetja Kganyago had highlighted in the January MPC meeting, saying if that were to happen, it would just slow down the pace at which they would be cutting rates. Your thoughts around that, your thoughts around what we are seeing playing out?
Yeah, so the scenarios that were painted by the governor at that MPC meeting included a stress scenario, but the oil price in that stress scenario was slightly lower than it is right now, and the rand was slightly weaker. But I mean, let's say it's more or less the same as that stress scenario. At that point in time, the MPC saw inflation moving closer to 4%, but still remaining within that tolerance band. So perhaps we're not at risk of hikes, but I think I agree with Dave. You're definitely in a space where we were really positive around some serious tailwinds for the consumer. So pretty disappointing in that regard.
You're absolutely right there. When it seems like we're getting things right, here comes the war throwing a spanner in the works, Jason.
Correct. I still think we've been speaking about this for quite some time now, where in the South African context, you've had all these incremental wins from a reform perspective. So this doesn't derail that. It just provides some headwinds for emerging markets. I think we here at Steyn Capital are firmly in the emerging market bull camp. But yes, this is certainly a speed bump along the way. I don't think it derails that weaker dollar story longer term.
Yeah.
But yeah, in the short to medium term, you are getting a stronger dollar, a lot of uncertainty. Markets don't like that. Central bankers certainly don't like that. And in the South African context, with a South African Reserve Bank that does have a hawkish tilt to it, you can probably guarantee at the next meeting we get what we would call a hawkish hold.
And you know what? I was really banking on that cut come the end of March. But yeah, obviously, cold water has been poured on my hopes. Let's move over to some questions, Chantal. You know, in these kind of scenarios, there are always winners and losers in equity markets in particular. And we've seen energy and defense stocks benefiting from the war. And a viewer here has a question around ExxonMobil and whether you see sustained upside, or is the market already pricing in supply risks?
Yeah, so I think that the moves we've seen on in terms of the oil producers have been notable. If I just look at Sasol, for example, it's a very similar scenario for most of the oil majors. You've had like serious operational inefficiencies. Most of these companies under a low oil price environment had to really focus on that. A lot of those improvements have been made, and now you're getting this risk though that the oil market is in a structural surplus, which means that prices under normal circumstances should be a lot lower than where it is under the stress scenario. So perhaps as a trade, something like that could make sense, but as a long-term holding, I wouldn't want to get involved. I would actually wait for the opportunity to get out of some of my oil exposure if the share prices correct any further to the upside.
What about you? What about you then?
You mentioned defense. There's structural support for defense stocks. So perhaps they've run a little.
All right, we seem to have lost Chantal there. Let's pick up on that then, Jason. She was talking about the defense shares, where we are seeing more of a structural support when it comes to those counters. I mean, we've heard from different countries, a number of countries upping their defense spending. We saw what played out at the NATO summit last year as well. Is that a sector you are seeing value in?
Yeah, look, I think probably not right now, based on what's moved, the share price moves have been over the last few weeks. But to Chantal's point, I think she hits the nail on the head there, where you, in the oil market, you've had this, you've got these headwinds, but yeah, you've got these structural tailwinds when it comes to defense. I mean, if anything, what's happening now is definitely going to push countries to invest in defense. The reality is we are in a multipolar world, and you are seeing that playing out right now in the Middle East. So definitely one where, yeah, there could be some value, but yeah, probably wait for a pullback to get involved.
A question here on African Rainbow Minerals, out with results today, asking for your views around that company at its current levels. Just going through those numbers, I noticed that while they received a boost overall from the PGM prices, the ferrous division, the manganese division not faring so well.
Yeah, it's also one of those where prices have been good. So we look at it, and I guess similar story to the likes of Sibanye as well, where you have these elevated prices looking really good, but it comes down to those production numbers, right? I mean, it doesn't really matter when it comes to the prices. Yes, okay, you can, but it all comes down to, can you get the stuff out the ground, and then actually have a sustainable path going forward. So yeah, it's definitely not liked by the market today, that's for sure.
Yeah, and given its exposure to Harmony, that strategic stake, do you view ARM as a potential catch-up within this environment?
Sure, in this environment, I'm not so certain with volatility about it, but yeah, that is an interesting thought. It's definitely something that could potentially happen.
All right, Chantal, let's try you again. We're talking about African Rainbow Minerals, which is out with results today, and whether you see value for that counter at current levels.
Yeah, so I do think that there is value. But there's a lot of execution risk in that space as well. They have several big projects that they're assessing at the moment. They're probably going to adjudicate on that over the next few months. And then there's the potential for an increase in capital expenditure. I think the windfall from higher platinum prices would have helped, but it's a risky one.
All right, let's look at a counter like Kumba Iron Ore that hasn't been experiencing price tailwinds like some of the other counters. Your take around that counter and whether it's a buy at these levels, just considering that the fundamentals are not necessarily strong, but the latest earnings look decent, Chantal.
Yeah, I mean, they're really strong executors. I think that when they are under pressure, they do make the necessary operational changes very quickly in order to get themselves in the best possible position. I think it's a great income portfolio for long-term holders, but in my core portfolio, I prefer to have exposure to Kumba through Anglo American. So I have a little bit more diversification.
And of course, key to the iron ore market is China, Jason. Of course, demand has slowed on the back of the downturn in the property sector on that front, and that weighing on prices. Looking at some of the other players, I mean, something like a BHP, which said that copper has surpassed iron ore as the miner's biggest earnings contributor for the first time. Your thoughts around Kumba and where it stands when it comes to, the metals that are gaining traction in this environment?
Yeah, so I think on the iron ore side, I think just some things to note, like, iron ore, it isn't rare. It's the fourth most abundant element out there. And really the trick is finding it in sufficient quantities and quality to mine, right? So we do see big new mines coming up in Guinea, and just as an example, Simandu mine, it's ramping up to, it's going to be about 3.5% of Kumba's annual volumes over the next 4 years. So you basically got an additional roughly 8% of the seaborne markets in supply coming on. So very much a supply story, which will be a structural headwind for these guys. And then to your point exactly, you got to look at China as well. So we've just had the new 5-year plan come out of China, downgrading growth expectations, still no major stimulus coming out. And with the property market not resolved, consumer confidence still down in the dumps in China, you have a combination of both supply challenges with too much supply coming on, as well as from a demand perspective, you need to really have a hard think about when are we going to get this turnaround in China as well. And so for me, not in my portfolio, but yeah, it's definitely something that needs to resolve before we would get involved in it.
And then I want us to turn over to wealth management with your view, Jason, on Quilter as a long-term bet.
Yeah, look, financial advisory is a high quality business. Quilter is a name that we have owned in the past. We don't own it currently. We don't see it as undervalued. Look, I mean, they reported decent results this week. So we
Yeah.
have seen that underpinned by record flows, disciplined cost control, and you are seeing that improved operating leverage come through, as well as they're gaining market share over St. James's Place as well, which is nice to see. And I mean, look, I mean, they're using some of the excess capital to buy back shares, I think to the tune of about 3% of the shares out, which is always nice to see. But yeah, I think from a share price weakness, what we've seen in it is that there is this increasing chatter in the UK that their model may be under some pressure from AI. But to be honest, it's hard to see how AI is going to completely replace financial advice. But yeah, there might be some pressure at the margin.
All right, so let's get your thoughts around Quilter, Chantal. I mean, Jason there mentioning how some analysts, there were murmurs around, I guess, AI weighing on the financial advisory sector. That's also been happening with the software players as well. So let's just get your thoughts around that, around the wealth, I guess, advisory sector as a whole.
Yeah, I mean, I think that AI displacement is completely overblown.
Yep.
And probably overblown in this space, giving of the machines. But the reality is people want to speak to people, and so I don't necessarily think that is a massive credible fear to mark a company down on. I agree with Jason. Quilter, I think, looks fairly valued at best, probably a little bit on the full side. It does have really nice structural support from some serious changes in the Pension Fund Administration Act I'm not sure that's exactly what you call it. That's what you call it here in the UK. So that's really helped them. And flows look good. Their platform is fantastic. They're gaining market share. It's a high dividend payer. So again, I think something that's really suitable for a dividend yield portfolio, but probably a little bit too expensive to buy right now.
Yeah. And just circling back to the war out in the Middle East, there's a question here on MTN and MTN's Middle East exposure and whether that is likely to weigh on earnings moving forward. Jason, of course, we got a trading update out from MTN following results from MTN Nigeria and MTN Ghana, which posted turnarounds on that front, and that fueling MTN's earnings.
Yeah, so I think from an MTN perspective, very much an Africa story. We're very bullish on the likes of MTN Ghana, MTN Nigeria, also doing really well. Both names which we've looked at from an Africa perspective. I think, yeah, so from a headwind perspective and MTN, these things aren't great, what's going on in the Middle East, but also South Africa has been really difficult operating environment as well. So it's very much kind of the focus for MTN needs to be on those African businesses.
And I mean, I was chatting to a business day writer, Mudiwa Kavaza, who mentioned that fair that we are seeing war playing out in the Middle East, but Africa has had, its fair share of issues as well, and MTN has managed to weather those issues as well. So they'll likely be able to survive what's playing out in the Middle East. Let's get your take on MTN then, Chantal.
Yeah, I mean, I think that their exposure to the Middle East is very small. Now they've gotten out of some of those. I think what's going to have a positive impact on MTN is a spike in oil prices that should put the Nigerian economy on a really good footing. So you need to think about both sides of the coin. I think they've got really good executional momentum at the moment in West Africa and in some of their other regions. So yeah, I think that is going to be the main business case for MTN and the main investment case for MTN over the next few years. They are executing well. That IHS acquisition the market initially didn't like, looked at the numbers and it makes perfect sense as well. So to an extent also.
Just your thoughts around what's been playing out in the food producers space then, Jason. We got results, yes, out from RCL, but I want us to look at what's been playing out with Lipster, right? Initially, there was a cautionary that the board is considering bids, that failing to come through, and a viewer asking if they should perhaps hold on to their Lipster shares or sell at this point and perhaps try and get into Premier.
Yeah, an interesting one. It's probably, I think probably hold on, tell you the truth. It's very good business, one we like as well. But yeah, it just comes back to that we're seeing a lot of this M&A in the South African space. But yeah, I don't have much more to add on to that one.
All right, we're going to just wrap it up on that note and get into your stock picks. Chantal, where do you see value at this point?
So there's lots of value in the market at this point. We've seen a sell-off in the SA Inc. space as well, but generally JSE shares under pressure. One of the ones that I think could benefit from a slightly weaker rand environment and that I think has been unfairly sold off is Richemont. So not an SA Inc. stock, but listed on the JSE. I don't necessarily think that there's going to be much of a disruption in terms of sales because of the conflict right now. And their momentum and execution has been exceptionally strong. I think this is a good entry point.
All right, Len, let's move over to Jason. Where are you seeing value at the moment?
Long-term investors and
so what one of suggesting is Grupo Sura. It's a Latin American financial service holding company listed in Colombia. It owns one of the region's largest pension fund managers, and as well as one of Latin America's largest insurance groups, as well as a 25% stake in Colombia's largest private bank. And yeah, the company's completed a significant restructuring last year, and they've been spinning off non-core assets, and they've been eliminating complex cross-shareholding structures. So this is leaving a focused financial service business trading at a roughly 6 times earnings. And then if we strip out that banking stake, you're buying the pension manager and insurer at just over 2 times earnings. So a lot of value and a fair bit of distance from tensions in the Middle East right now too.
All right, let's leave it there. Chantal, Jason, thank you so much for your time this afternoon. Chantal Marx there from FNB Wealth and Investments and Jason Horn from Steyn Capital Management. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.